Two people open the year with $10,000. One puts it in a savings account. The other borrows $10,000 to buy an asset. The saver did everything right. The borrower did everything the textbook warns against. And yet, by the end of the year, the borrower comes out ahead. That's not a mistake. That's the system working exactly as designed. Here's why this matters right now. Inflation has spent the last several years running hotter than most people's savings accounts can keep up with. In the US, inflation peaked above 9% in 2022. Savings accounts, for most of that time, paid closer to zero, drifting up to maybe 1 or 2%, even as prices kept climbing. That gap isn't bad luck. It's a quiet, permanent feature of how modern money works. Most people think of inflation as prices going up. That's true, but incomplete. Inflation is also debt going down. Here's the mechanism. Say you borrow $100,000 today to buy a house. 10 years from now, thanks to inflation, that $100,000 is worth meaningfully less in real purchasing power. Your income has likely risen with inflation. Your debt has not. You're paying back the loan with dollars that are easier to earn than the dollars you originally borrowed. Debt doesn't inflate. It sits still while everything around it moves. Now, flip it. Say instead of borrowing, you save that $100,000 in cash or a low-interest account. 10 years later, that money buys noticeably less than it did the day you saved it. You didn't lose the money. You lost what the money could do. Economists have a name for this. It's called a hidden tax. Nobody sends you a bill. Nobody files paperwork. It just happens, quietly, to your purchasing power. Every single year, inflation outpaces what your savings earn. Run the numbers. At 3% inflation, money loses roughly half its purchasing power over 23 years. At 6%, that timeline cuts in half again. If your savings account pays 1% while inflation runs at 4%, you're losing 3% of your real wealth annually. Not might, are. Every year, without exception, as long as that gap exists. Meanwhile, the borrower holding a fixed-rate loan is quietly benefiting from the same math working in reverse. This is where the system reveals its real design. Governments themselves are the largest debtors on the planet. The U.S. federal government alone carries debt exceeding $30 trillion. When inflation rises, the real value of that debt shrinks, even as tax revenue tends to rise with inflated wages and prices. Inflation quietly makes government debt easier to manage, without a single politician having to raise taxes or cut spending to do it. That's not a conspiracy. It's incentive, the same as anywhere else in finance. Whoever owes money benefits from inflation. Whoever holds cash pays for it. And that flips almost everything people assume about financial virtue. Saving is taught as the responsible choice. Debt is taught as dangerous. But under sustained inflation, the saver is silently taxed, while the borrower is silently subsidized, provided that borrower use the debt to buy an asset that holds or grows in value. That's the crucial distinction, and it's where the hype and the reality split apart. The hype? Cash is safety. Debt is risk. The reality? Cash guarantees a slow, invisible loss during inflationary periods, while debt tied to real assets, like property or productive investments, can transfer that same loss onto the lender instead of you. This is not an argument to borrow recklessly. Debt without an asset behind it, credit card balances, high-interest consumer loans, still destroys wealth, often faster than inflation ever could. The distinction that matters is simple. Debt used to acquire something that appreciates works with inflation. Debt used to fund consumption works against you. Inflation or not, the saver isn't wrong to save. But saving in cash while inflation quietly erodes it year after year isn't caution. It's a slow bleed dressed up as safety. Zoom out and the implications get heavier. Entire generations built financial habits around a world where inflation was low and predictable, where a savings account felt like enough. That world existed for much of the 1990s and 2000s. it has not reliably existed since. If inflation remains structurally higher in the decades ahead, driven by aging populations, higher government spending, and shifting global trade, the quiet tax on savers doesn't go away, it compounds. And the people least equipped to respond, those without access to credit, without assets to borrow against, without financial literacy to understand the mechanism, are the ones who absorb the most damage. Inflation doesn't just erode wealth, it erodes wealth unevenly, and it erodes it toward the people who can least afford it. Meanwhile, those already holding assets and the debt used to acquire them watch the same inflation work quietly in their favor. The system isn't broken. It's functioning exactly as monetary systems have functioned for a century, transferring value from those who hold cash to those who hold debt against real things. Nobody announces this transfer. There's no ceremony, no headline, no line item on a bank statement that says value lost to inflation this year. It just shows up later as a widening gap between people who understood the mechanism early and people who trusted their savings account to protect them. The real question isn't whether inflation will keep doing this. It's who still doesn't realize it's already happening to them.